Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Thank you again for joining me for another video of our monthly update. Another great video. I always have to cut out things. There's so much material to go over. Seems like this year we've had about 10 years worth of stuff that has happened, but I condense it down to about 25 minutes. First 18 minutes for the high level and then the extra time for the extended version. I hope you all enjoy it. I hope you have a good October. These elections are going to be done before you know it. Thanks for joining me and enjoy the show. Okay, so here are the asset class returns for September. As you can see, overall, it was not a good month. It finished off pretty good. It could have been a little bit worse, but luckily we had a couple good days there at the end of September. But as you can see here, for the month, we were down about 3.8% for the S&P 500. Down about 4.7 for the small caps. So the S&P did a little bit better than the small caps. But real estate actually didn't go down as much, 2.04, but still down. Developed international was down 2.2. So again, doing a little better than the S&P 500. Emerging markets down about the same, 2.2. And the fixed income aggregate type bonds, those were up just a smidge. High yield was down just a little bit, minus 1.4. And gold for the second month in a row is actually slightly down, but still having a huge performance, as you can see, year to date up 28%. So as you can see, overall for the year, the market is generally kind of flat to maybe slightly up, but barely when you include all the different asset classes. But we had a tremendous quarter, so you'll see those results soon. But as you can see, for the month of September, kind of taking a little bit back from what we made in August. So as you saw in the asset class returns, we were down a little bit for the month of September. So what were the driving forces to the slowdowns? Well, first of all, what happened was we had the highly valued tech sector, which many people argued got a little too expensive, had a pretty decent correction. They led the way down for the markets, which was good that we were trimming things back in August, some of those areas. Although I will say that they've been holding up pretty well here in the last week or so. But because of that, that really made a big difference in the markets. As you know, tech is a pretty big component now of the S&P 500. We also had the COVID-19 stats, although pretty stable here in the U.S., has been coming up at a pretty good clip in Europe, and of course that gets people afraid, obviously, in Europe on the possibility of maybe more shutdowns, but also what could happen here in the United States, and maybe they're a precursor to the U.S. And then we've been getting lots of economic numbers coming through. Depending on the way you want to look at it, the economic numbers continue to improve and look pretty strong. But what we're noticing here in the month of September, and we started to see a little glimmer of that in August, was that the rate is starting to slow down. So I pointed out consumer spending. It's getting better, but the rate of better is slowing down. The PMIs, which are surveys of companies, service companies and manufacturing companies, better, but again, starting to the rate of improvement is slowing down. Initial jobless claims the same. And just this morning we had the unemployment rate and the unemployment numbers for the month of September, and it was a good number, over 600,000 new jobs, unemployment down to 7.9, but it was less than expected. We were hoping that it would at least try to continue at the clip that it was back in August, and it didn't. And so One of the big things I think that has to do with this kind of slowdown is the fact that the stimulus essentially ran out at the end of July for many, with the PPP and many unemployment benefits, and it hasn't been renewed. And as you could see, and I think one of the things that we're seeing today with the numbers of the unemployment numbers being good but not as strong as we hoped, is that it looks like we might need a little bit more stimulus. I call this the booster shot. We need a booster shot. We had a good shot back in March and April, but we need a booster just to get us through to the finish line. I'm sure you all saw the news. Trump has COVID and his wife and maybe more in the White House. And so what's interesting with the unemployment numbers and with Trump having COVID, the market today is actually showing signs that maybe a stimulus could be more likely than it was yesterday. And so I'm still about 50-50 that it's going to happen before an election. I hope it does for the sake of the folks, but it's still not 100%, which is why the market again has been struggling a little bit here in the month of September. So now, as always, what's really more important is the outlook. So the way I framed it was last month just a bump in the road? Well, the answer, I think, is yes. At least that's my opinion. And so here's some of my thoughts as far as why I think that is. First of all, and probably the most important point I'm going to make in this outlook slide, is these Abbott Lab quick tests. They're going to be $5. You're going to be able to find out if you're positive or negative in 15 minutes. There's going to be an app, and you're going to find out very quickly from the app, and you'll be able to use it to show if you get on an airplane, go into a store, that you've been tested and when you were tested and what your results were. I think this is kind of a game changer. Now, the only problem is it's not readily available. They started coming out at the end of September. They're starting to come out more and more in October. I think the government essentially bought them all from Abbott Labs for now. They're handing them out to schools and to cities, obviously where they're most needed at the moment. But I could see that over the next month or two that this could really change a lot for the economy. If people can start flying, people can start going on cruises, maybe going to events because they have more confidence that everybody that's in there has been tested and it's actually economical to get the test. And so I'm very excited, and I think this could be a good opportunity for the economy to start making a little bit of a comeback. So that's why I think a lot of what we saw in September could be a bump in the road. Now, obviously, the big thing is the vaccine, also therapeutics. This one's sometimes not emphasized enough. The therapeutics, there's been a lot of great strides made in that area as well. But the vaccines are coming along. The results seem to be pretty good. They're being very careful. Looks like we might even have some emergency use vaccines by the end of the year, but most likely you and I probably won't see them until next year. It's just a matter of when. Hopefully first quarter, possibly second quarter. But if we have the therapeutics and we're doing all the testing through these quick tests with Abbott Labs, I would say it's pretty darn close to being as good as having those vaccines available right away. So I think this could be a very, very big change. And so my opinion is I believe the market is overpricing the risk of a second wave. And I'll get into that a little bit more if you watch the extended version. I'll show you the VIX and how it looks like in October and November. And obviously a lot of that has to do with the election as well. So there's the second wave and there's the election risk. I think things are being overpriced in that area for risks. The other thing that I'm going to talk about a little bit more in the extended version is that there are some COVID trade opportunities. Now these are types of stocks that maybe would do better in recovery in some of the areas that have been really beaten down. Now I would say it's probably a little early right now unless you're really brave, but there's definitely an opportunity very soon coming in with those. The pricey growth stocks are probably still likely to continue to do well. In the extended version, I'll get into a little bit more of the nitty-gritty there, but essentially when interest rates are low, and they've stayed pretty low, and even today with the stimulus news maybe getting a little brighter, interest rates are still staying right around 0.7 for a 10-year treasury, which is super, super low. In that environment, growth stocks and bonds will do pretty well. And so it's not time to get out of growth in those large cap techs, but it's definitely an area that I think with the value trade that COVID-19 could be a better opportunity going forward. And so lastly, I'm going to point out that I have been a little bit more aggressive in my positioning of stocks, although I haven't been adding more to stocks. I've been going a little bit from growth into more small cap and international and value type stocks. Although with what I've seen in the economic numbers and the slowdown in the rates of improvement, okay, I've been slowing down my rate of changing and doing these rebalancing trades. But I can see how in the end of the year that could change as we get closer to a vaccine and get past the elections. Okay, for the educational slide of the month, I have a piece about Joe Biden's tax plan. Now, of course, as we watch the media, we hear hyperboles on both sides about these tax plans. And so I thought it'd be useful to actually take a look at it and talk about it in a apolitical way. Anytime I bring up politics, I always try to tiptoe and try to stay away from the partisan side of things. But I want you to see what they actually are. First of all, I would say there's going to probably be some negative effects to the economy to some of these plans, but maybe not as bad as some folks make it out to be. And of course, the bottom line is how much of these tax plans are actually going to get implemented, because these are just proposals. And a lot of it will also depend on if Joe Biden is going to be accompanied by a Senate that is held by the Democrats as well. And so there's a lot of things that are going to probably hedge this from even happening, especially with COVID still the number one thing to consider as the next president goes into the first year. But again, with all those things being said, it's still important, I think, to see what these proposals are. Now, there's a lot of proposals, and so I just kind of picked some of the highlights. So please forgive me if I missed out on one that you thought was important. I just want to highlight some of the big ones. And the first one I would start out with is it looks like the proposal is to raise the tax rates a little bit, not a lot, but a little bit, from 37 to 39.6 for those making over $400,000 in income. And also it looks like anybody making over $400,000 in income will have to pay more into Social Security, because right now, once you get to about 130 or so, they don't charge you any more Social Security tax. Okay? So that's kind of not a big one, but it's going to affect quite a few people, I'm sure. The next one is long-term capital gains. Now this one's only going to affect those making over $1 million, but it is a pretty significant, it's a huge difference in the capital gains rates now, which are around 20%, and qualified dividends, which are at 15%, and they're going to make it all count as ordinary income, which again goes to that 39.6% level. So we're talking potentially a pretty big hike. Again, luckily it's not for the majority of folks, only for those making over $1 million. And then we have the elimination of the step up in cost basis. I put this one in here because I figured a lot of my clients might be interested in this. So this is essentially when you pass away and you give your taxable money to your kids, your family, they don't have to pay any taxes when they sell the securities because they inherit the cost basis at the date of death. Now, over time they would, but right after your date of death, it would essentially be zero taxes. They would eliminate that, which means that if you bought Google, for example, for $10 and it's worth $100 when your children inherit it, they're going to have to pay the $90 in capital gains tax. It doesn't go away like it does today. So that was a pretty significant one for inherited assets. The last couple I think are pretty big for the economy. Okay, corporate tax rate increases from 21% to 28%. Now, we're at least not going back to the 35% where we were before the big tax changes back in 2017. But that is a pretty significant hike in the corporate taxes, and that will have an effect on the economy and stock prices because it's going to affect earnings. The last one I'll leave you with is setting a minimum tax rate for corporations. This is, I guess, to address the Amazon effect where, they were paying very little, if any, in taxes. Now, of course, they get a lot of tax credits and incentives to go and open up warehouses in different places, which is probably some of that reason. But what they want to see with the Biden proposal is that every corporation pays at least a minimum tax rate. Now, on the surface, that kind of seems fair, but that can also create a pretty big tax, depending on what that minimum is, for a lot of corporations that maybe have a lot of expenses in doing research and development or getting tax incentives because they're so popular and they can produce a lot of employment in certain cities. And so it'll be interesting, but I would say overall, this is kind of a net negative for the economy. I would hope, and you can make the argument that there's other policies that would be good for the economy, like their plan on maybe reducing the tariffs and having less of a conflict with our trading partners. But again, that might be a short-term gain and a long-term loss. Who knows? But the bottom line for now, I see this as kind of a slight negative. Not a huge negative, but a slight negative to the economy if these things do get implemented. Well, and I always like to close out with an inspirational quote. And this is one of my absolute favorites from Zig Ziglar. He says, "If you can dream it, then you can achieve it. You will get all you want in life if you help enough other people get what they want." And so I've always loved that one because it's all about what you give is usually what you get back in return. And so just a little reminder of being good and doing good to others is really the best medicine, isn't it? Thanks, guys. We'll talk to you later. Alright, so here's the chart I was talking about in the market update piece about how in the US things have been stabilizing. You can argue there's been a little bit of a blip up here, but it's still pretty much stable for the last several months. And you can see how in Europe the case counts have been coming up quite a bit. Now luckily the fatalities have been pretty low really in both continents. And so that's encouraging. And just like last time when cases started to go up, there was a lot of concerns. But as those fatalities kind of stayed in check, I think the economy kind of started to settle down. And hopefully that will be the case here too. Now here's the charts for the leading indicators. Again, I started to put these side by side. On the left we have last month's, and this is this month's. And again, the red shows kind of the average of where all these different leading indicators that I mentioned a few of them in the market update. As you could see, last month things were improving and they were positive. So that's why they were on the upper half of the chart on the right. And what we're starting to see now is things are positive, so they are improving, but it's slowing down. It's a declining quadrant. And so that's not a good sign if that continues. That might be that things are going to slow down and maybe go the other direction. I hope that doesn't happen. I hope with the stimulus and maybe as we get closer to these vaccines and the therapeutics and the testing that we can reverse the course of this. So I mentioned a few things in the Outlook segment of the video, and one of them was my thought that the market is overpricing the election risk. As you can see from this chart here, this is the highest, the VIX differential between November and October that it has been since the beginning of the year. And so I think some of that is also because of COVID, maybe potential second wave. But as you can see, this is much higher than it's been any part of the year. And I think that's probably a little overblown. We shall see. I might be wrong, and so we got to play it kind of safe and not reach too far. But again, I think the market's kind of overpricing this at the moment, which could present, again, a decent entry point opportunity. Okay, you heard me talk about the COVID-19 trade. This chart shows you the correlation with the vaccine optimism and different segments of the market. And as you can see here, value stocks, and these are financials, industrials, transportation companies, these are the ones that are going to have the biggest uptick in economic performance when the vaccine is out and people are finally getting back to normal. And what you can see is defensives, the S&P in general, even some of the cyclicals, but mostly the growth stocks are the ones that are going to probably see a little bit of a slowdown when things start getting back to normal. So that COVID-19 trade, I think, is getting pretty close to maybe starting to be opportunistic. And finally, you heard me in the Outlook talk about how the growth stocks, yes, they are pricey, but how they're going to probably continue to do pretty well, especially in this low interest rate environment. Even if rates go up a little bit, it's not going to make a huge difference unless it goes up quite a bit, and which I just don't see happening probably within the next year, maybe even longer. And so what you can see here is what they call the equity duration. Duration is the sensitivity that it has to interest rate changes. And as you can see, growth stocks have the most sensitivity to interest rate changes, and value stocks have the lowest. And so if interest rates are going to start moving up very quickly, you can see how growth stocks are going to be hurt more than value stocks. Now what we're seeing right now, again, is interest rates are not going up very much, and if they do, they're going to probably go up pretty slowly. So again, this is going to present an opportunity to continue to have growth do pretty well. Even if they don't perform as well as value, it will probably still do pretty well in this type of environment.